And welcome to this episode of the Capitalized Life and Retirement Show. I'm your host, Matthew Johnson, president and owner of Johnson Wealth and Income Management, a retirement income source located in Clear Lake and Humboldt, Iowa, serving clients in northern Iowa and southern Minnesota. Well, how are you today? I hope you're doing well, taking a little bit of time for yourself, and welcome to today's program. Today, maybe this is going to be kind of a bit of a provocative title. Today, we're going to be discussing the dirty secrets of the life insurance industry. That's right. There's so many, I think, things that we've kind of picked up on over the course of time when it came to the financial services world, and we know what to kind of pay attention to and what to stay away from. But when it comes to something as kind of ho-hum and mundane as life insurance, well, oftentimes we think, well, life insurance is life insurance. But let me tell you, life insurance companies are one of the most profitable industries, or shall we say companies or business models within the financial services world. They're not in this business for charity. They're in this business to make money. And, well, guess what? They make a lot of it. Now, making a lot of money isn't a bad thing. I want you to make money. I want them to make money. I think that the life insurance companies serve a very wonderful service to communities and to societies and to families. And for those that sell life insurance, myself being included, life insurance is one of those things that we have seen provide such beneficial emotional support and peace of mind to those family members that are grieving after they've lost a loved one, a breadwinner. But today, there's things that we want to break down. And if you have life insurance, if you have any kind of life insurance, I hope to be touching on the type that you have, and I hope to be helping you better understand the things to be watching for, the things to be paying attention to, so that you can get everything that you want and then some, and maybe even do it for a lot less money. Now, if you're brand new to this program, I just want to say a warm welcome. If you've been looking for a place to come where you can become educated without feeling the pressure of a sale, if you're looking for education to deepen your understanding and your knowledge of certain financial terms and strategies and techniques, things of that nature, well, Johnson Wealth and Income Management and this radio show, The Capitalized Life, is here to help you do just that. I encourage you to go to our website, Johnson, W-I-M, as in Wealth Income Management, where you'll find just a whole host of resources. You'll be able to watch previous podcasts. You'll be able to listen to previous radio shows. You'll be able to read the multiple different white papers that are educational on certain relevant, specific financial products and topics and strategies and techniques, things to help you further your education so that not only can you make good decisions, but you can make good decisions that will benefit you not only now, but in the future. I also encourage you, take a look at my book. If you've been looking for something that's down to earth, something that's common sense, something that can help you basically better understand why you may need to be changing your focus and your purpose of how you're investing your money between now and the time that you do retire, or if you're in retirement, why that change may be necessary right now at this very moment. Well, The Capitalized Retirement may be the book for you. It's available at all major book resellers and at a reasonable price. So let's get into this. Now, I'm going to be discussing basically life insurance in two different forms. And of course, we know that there's many different varieties of permanent life insurance, but that's going to be one of the types of insurance that we're going to be discussing. And underneath that umbrella of permanent life insurance, we can basically include types of policies like whole life policies, universal life policies, variable life insurance policies, indexed life insurance policies. Those are going to be, for the most part, covering the vast majority of permanent life insurance policies that are out there. Now, In addition to that, the second umbrella of life insurance that we're going to be discussing is going to be term life insurance. Now, you might have some life insurance, but you may not even know what kind of life insurance you have. And if anything, I hope maybe today's conversation stimulates and kind of encourages you to go back and figure out and maybe pull some of those papers out and look a little deeper as what those statements are suggesting that you have. If you don't get a statement, well, chances are if you're still paying a premium, you might be having term life insurance drafted from your bank account. But in no particular order am I to say that one type of insurance is better than another. I've been asked the question multiple times in my nearly 3 decades of being an advisor, what kind of life insurance is the very best? And the most honest answer that I can give you is the kind that's in force when you die. That's the best kind. I don't care if it's term. I don't care if it's permanent. I don't care what kind of permanent it is. I don't care how long the duration of the term was. As long as it was in force, that's the best kind of life insurance to have. So let's get started. Now, again, I entitled this The Dirty Secrets of the Life Insurance World. And one of the things that we need to kind of think about is how our world has changed so much financially. What we are living through today economically compared to how things were back in the 80s and the 90s. And as we think about many of the people today that are getting closer to retirement, you've been given the handle the boomers. Well, what that really means is that you've got life insurance that you probably purchased back in the 1980s and in the 1990s. Now, just think about what was going on in America economically during that period of time. Well, the most obvious answer for most individuals who know the history of economics during that time is that we had extremely high inflation. And not only that, but we had extremely high interest rates. Those interest rates were massive. We were able to get CDs that paid 10 and 12 and 15, as much as 18%. Permanent life insurance companies were paying 14 and 15 or more percent on the cash value in their life insurance contracts. Now, why is that important? Is it really important? Well, the answer is it is one of the most important tenets that we could probably start with. You see, one of the dirty little secrets about the insurance world is that permanent really doesn't always mean permanent. You see, we are sold these quote unquote permanent policies so that regardless of when we die, whether we die 5 years after buying our policy or we die 70 years after buying our policy, we know that that policy is going to be enforced. We know that that policy is going to pay a death claim, a tax-free death benefit to our family, whether it's our loved one or children or grandchildren, whatever the case may be. But you know what? More and more of those quote-unquote permanent life insurance policies are terminating. They're imploding. They're going under and disappearing. People don't know why. People feel as though they've had a bait and switch. And you know what? Quite often they have. You see, when we think about selling permanent life insurance, meaning life insurance that is supposed to last the rest of our life insurance that is oftentimes building up a cash value within inside of it. Well, the interest rate that our country was paying during that period of time in the 80s and 90s was very, very large. And when an agent is selling a life insurance policy and he's designing the policy, he's trying to determine how much premium per month that person is going to likely be able to afford to pay into that policy for a specific amount of death benefit for a specific period of time. The key phrase that agent probably used with you was based upon current cost of insurance and current interest rates. Now, here's the sad part. Both of those things, the cost of insurance and the interest rates, have changed. And I bet you're able to guess which direction they each went. If you're guessing that the cost of insurance went up, the answer would be absolutely. Because with permanent life insurance, even though we might have a premium that we pay every month that stays the same, the reality is that internally inside that life insurance policy, as we age, we get older, we're getting closer to death, that company is charging us a higher cost of insurance every single year. So that means that the internal cost is going up. Now, the interest rates, what has interest rates done since the 1980s and late 1990s? And the answer is simple. They've gone from double-digit rates of interest down to the single digits of interest rates. Now, granted, back in 2023 and 2024, we had interest rates that were actually halfway decent, right? We could see where we were able to get a CD that paid us 5%, sometimes 6%. But what has happened to the CD interest rates, or just interest rates in general, already since October of 2024? What we know is that interest rates have fallen. And see, these insurance companies, back then, they didn't even realize that it was possible for interest rates to go into the single digits. This is the reason why so many of those older, quote unquote, permanent policies had interest rates that were guaranteed to be as high as 4.5%, maybe even 5%. And so even though that's a very high threshold of guaranteed minimum interest that is being paid by the insurance company on the cash value of your life insurance, well, unfortunately, the cost of insurance on many of those older policies, well, it's devastating and cannibalizing all the cash value that you have earned. So your cash value is being depleted. You see, let's just think of it this way. Let's assume that you have a policy that actually has an internal cost of $75 per month. And let's say that you're paying a total of $60 per month. Where does the extra $15 come from? Well, that's the cash value's job. And so in the same way where early on in the life of that permanent policy, you were paying more than what the cost was and you were building up cash value, as your cost of insurance goes up, but your premium stays the same, it now becomes the burden of responsibility for your cash value to cover the balance. And when that cash value isn't earning the type of interest that it once was, this is where people find themselves seeing their policy cash value dwindle and ultimately watching their policy implode. Now, you want to do something about it? Of course you do. So sit tight. We're coming up to the first break. When we come back, we'll talk about how do we stop the bleeding. Sit tight. We'll be right back. And welcome back to the second half of the Capitalized Life and Retirement Show. I'm your host, Matthew Johnson, president and owner of Johnson Wealth and Income Management, a retirement income source located in Clear Lake and Humboldt, Iowa, serving clients in northern Iowa and southern Minnesota. If you're just joining us, welcome to today's program. Today we're discussing life insurance, but most importantly, we're discussing the dirty little secrets of the life insurance industry. And we kind of started in the first half of our program identifying that there's really kind of two different kinds of life insurance. There's permanent life insurance, and then there is term life insurance. And we haven't gotten into that yet. But we've identified that with so many of today's permanent life insurance policies, they're imploding, they're disappearing. And why is that? Well, we've had a bit of a death cross that has taken place. The cost of insurance has gone up drastically as you have aged. And so as a result, the insurance company is charging you more and more. Now, the cash value that you had built up over the course of owning your life insurance policy, unfortunately, it's making quite a bit less in interest than what it did when it was originally written, probably back in the 80s and 90s. And so as a result, you're in this position where the cost of insurance is eroding your cash value. Your cash value is disappearing before your very eyes. And if you don't have enough cash value, you don't have enough premium coming into that policy to keep that policy going, well, guess what? Your permanent policy will not be a permanent policy. You will have effectively outlived your life insurance. So how do we stop this? Well, first and foremost, I'd like to say that, every insurance agent that writes a life insurance policy is responsible. He reviews that policy with his client every, say, 3 to 4 years, something like that. He calls on them. He answers questions. He does all of the due diligence and the maintenance necessary for those permanent policies. But the reality is that doesn't happen. 9 times out of 10, maybe 9.8 times out of 10, that does not happen. The agent has retired, the agent has died, the agent has moved on. In fact, many of you have life insurance policies written by companies that are no longer in existence. They've been absorbed and bought by other companies, and maybe you've gone through 2 or 3 or 4 name changes. So, how do we stop this? Well, the first thing is that you need to be absolutely paying attention to your annual statement. If you get an annual statement, you don't know how to read it, I encourage you, get with your advisor. Find a financial advisor, a fiduciary, someone who is able to help discern and identify for you the important parts of that annual statement. Now, when we think about our life insurance policy, if we have cash value, we need to know if we've got enough cash value to get us through the duration of whatever age we feel comfortable that we may be dying. I'll give you an example. So I've got a client who is in fairly poor health. He feels as though he's probably going to not make it any further than age 85. Now, in this case, we want to make certain that no matter what permanent policy he has, he's going to be able to have a death benefit that is guaranteed out to age 85 or beyond. We wouldn't want to see his policy terminating at age 78. So in order to be able to do this accurately, we're not guessing, we're not crossing our fingers and toes. We're calling directly into the insurance company, not the agent, but to the insurance company, and we are ordering something called an in-force illustration. This in-force illustration, I want you to think of it as hooking your life insurance policy up to an EKG machine. It tells us how healthy the policy is. It's able to project into the future based upon the cost of insurance as it goes up and the interest rate and the cash value and the premium that you're paying. How long the company expects that policy to last. And guess what? It gives you the bird's eye view to see if your policy is going to make it. And if it doesn't, the great news is, friends, that it gives you an opportunity to fix it before it's too late. So many people have watched their policies terminate. They've watched their policies lapse without value. And all of those premiums that they've paid all of those years, it's money down the drain, money wasted. And that to me is an absolute shame. If I'm going to buy life insurance, I want that insurance company to pay that claim. I want to suck them dry for every time that they're obligated to. I want them to pay. And so as a result, I need to do my due diligence to keep my policy in play. Now, a little variation of this is, well, Matthew, what happens if I get this in-force illustration back and I realize that, well, there's enough cash value that, my policy is going to last as long as I want? Well, great. Then what you want to do is you want to order a second in-force illustration, except this time you're going to be asking the company to discontinue the premium that you're paying currently at a particular age. So we'll go back to my client. He doesn't think he's going to make it to age 85, but right now he's 62, and he's not planning on retiring until he is 65. So what we want to do is we want to order in-force illustrations that show him paying premium for essentially 3 more years, and then the premiums stopping. Now, what we're really doing is now we're testing the mettle of the cash value. We're trying to identify, does he have enough cash value, even if he stops paying the premium, to keep this policy running to his age 85. And so that's another in-force illustration, but it's putting you in the driver's seat, allowing you to be able to set the criteria that you want to see the insurance company try to shoot for. Now, let's say that you have a whole life policy. You've got a bit of a unique animal. On a whole life policy, you may end up having what's called dividends. And those dividends, more often than not, are used to do something called buy paid up additions. These are additional bits of life insurance or death benefit that the policy is going to have. So you may have started the policy at $50,000, and as the dividends got paid to you, they bought little bits of insurance, $130 here, $180 there, and before you know it, your policy is no longer worth $50,000 in death benefit. Now it's worth $68,289. Now, what can be done with the dividend? Well, the dividend is a beautiful thing because you can stop paying your whole life policy if you have enough dividends to be able to cover the cost of your insurance. Instead of having that dividend, buy paid up additional insurance. Instead, just switch your dividend option so that it reduces your premium. And if there's enough there that it can pay all of the cost of insurance, then whatever excess can be used to buy more paid up additional insurance. And this is something that you have complete and total power to do. You call the insurance company. You tell them exactly what you want done with your dividends. Shucks, you can even have the dividend paid directly to you if you want to. And I don't recommend it, but it's something that you can certainly do. So cash value really is the lifeblood of a permanent policy. But today, too many policies are lapsing without value. Too many policies are imploding before a person's eyes. And it's simply because no one has taught you how to preserve and to protect that policy. Now, if you're in a position where you don't have enough cash value, what can you do? Well, you can always increase your premium. You can always reduce the amount of death benefit that you have on the policy, making the cost less expensive. There's lots and lots of things that you can do. And if you have a whole life policy, you can even take something called a reduce paid up policy. That's basically where you just say, you know what, I'm going to forfeit all of the cash value and I'm going to give it to the insurance company. And in return, they're going to give me a policy that is guaranteed to my age 100 or whenever I die. Something that allows you to have at least some death benefit instead of jeopardizing all of it. Now, let's switch gears. Let's talk about term insurance. Term insurance, very quickly, is the purest form of life insurance. You pay the premium, you have the death benefit. You don't pay the premium, you don't. And term insurance is, man, it is a money maker. Many years ago, I saw the statistic that less than 2% of all term insurance policies that are ever written are ever claimed on and paid out. If that's the case, that is a wonderful statistic if you're an insurance company, because it means that you've collected a lot of premiums and you've never had to pay out a death claim. However, again, we want to make certain that if we're buying a life insurance policy, that it's doing its job. It's paying a death claim. Now, of course, in this particular case, term insurance is somewhat limited. It's not really designed to go your entire lifetime. Term insurance is bought in term lengths. So you can buy a 5-year term, a 10-year term, a 15, a 20, a 25, or a 30. Typically 30 being the longest time frame that you can buy. And this is the reason why I encourage clients, if they want cheap life insurance to cover a mortgage or something of that nature, you want to buy the longest term possible, because guess what? It will keep your death benefit the same. It will keep your premium that you pay the same. There will be no ability for the insurance to change anything. But what's a dirty little secret? Well, aside from the fact that most insurance companies, most policies, term policies that are written aren't claimed on and paid out, one of the dirty little secrets is that at the end of the term, you're out of guarantee. And it's at that point that the insurance company is going to skyrocket the amount of insurance premium that you have to pay if you want to keep that policy. Now, here's the thing. That's because they want to get rid of you. They don't want to pay a death claim. And the older you are, the closer to having to pay that death claim they feel you are. So it behooves them to scare you away. And you're basically saying, I'm not going to pay that premium. It's too much. That's unaffordable. And then they're going to say, oh, well, just go ahead and lapse the policy then. Well, there goes all of those premiums that you ever paid. But what happens if you really want the insurance? Well, welcome to something called convertibility. Now, you have to be careful because at some point you may be beyond the age of convertibility, but this is where you can take a term insurance policy that was slated to be temporary, to only last a period of time, and you can convert it to a permanent policy. And guess what? You could be sick with cancer. You could have heart conditions. You could have any number of different health maladies, and you would be guaranteed to get that permanent policy. It's typically going to be done without evidence of health. You just have to sign the forms, and then you have to prepare yourself for the amount of premium that the insurance company is going to charge you for converting from that term policy to the permanent policy. Now, with that being said, we want to make absolutely sure that life insurance is being used appropriately. Not every single person needs life insurance, although life insurance and tax-free death benefit being paid to a grieving widow or grieving spouse, children and grandchildren to create a legacy, I've never seen a person refuse that check. So it's a wonderful thing. And quite honestly, life insurance death benefit is, well, it's a permission slip to spend your retirement, because if you spend your IRA and your Roth and your post-tax money, you're going to be able to recoup that for your family if you have a large life insurance policy. But be careful. Know the type of life insurance that you need. Insure adequately, not over and not under. Make certain you're working with a reputable insurance company and a reputable agent. Make certain you work with a fiduciary if you want the best of the best. I'm Matthew Johnson. Thank you so much for listening and watching. And remember, it's up to you to make today a great day.